your price target for Bitcoin in the next 90 days, $1 million. I said, what? And so we're very positive on Bitcoin as well. But your forecast was in the context, apparently, and we'll get into this, of sort of the hyperinflation associated with fiat currencies. So I just thought it would be a fascinating conversation because you've thought very carefully and intensively about this, Balaji. Lots of, really what we're doing here is seeking to find the truth, what actually is going to happen. We're very positive on Bitcoin as well, but your forecast was in the context, sort of the hyperinflation associated with fiat currencies. And our optimism is more a function of fears of deflation and counterparty risk. And both of those should accrue to Bitcoin's benefit. Bitcoin as an insurance policy, a flight to safety against confiscation of wealth. So I just thought it would be a fascinating conversation.
Cathie Wood and Balaji, the guests of this video, have opposing viewpoints but both predict a significant increase in Bitcoin's value. Cathie believes Bitcoin will benefit from deflation and counterparty risk, acting as an insurance policy and a flight to safety, but the guest predicts Bitcoin will reach $1 million due to hyperinflation caused by a loss of faith in the traditional banking system. They discuss the fragility of the banking system, the role of Bitcoin as a safe haven asset, and the potential for cryptocurrencies to offer more transparent and decentralized financial services. Flight to safety, as we call it, with people seeking alternative options like Bitcoin and other safe haven assets due to concerns about the banking system and low interest rates.
The yield curve inversion has always led within 12 to 18 months to a recession. And so I was pointing to that. Commodity prices were falling. The oil price peaked at $130 in March of last year, I believe, and has been nearly cut in half. And I finally wrote a letter to the Fed. I don't know if you saw that, Balaji, but which basically said, wait a minute, you're hiking interest rates 75 basis points at a time, and hiking interest rates faster than any other Fed in history, 20-fold within 1 year, it turns out. And here are these conflicting signals, and you're voting unanimously to raise the rates like this. And so I have been much more concerned about deflation. And I think the bank crisis has punctuated that because, and we can get into this later, the two big mistakes that banks have made was assuming that interest rates would stay very low for a long time because the Fed told them that during COVID. And so they invested in long-term government-backed securities, figuring out they'd be money good when they matured. So that was the first mistake. And then the second mistake was to assume that deposits would not leave the system. It wasn't just Silicon Valley Bank. Deposits are leaving the banking system because money market rates are so much more competitive than what people are getting in their bank accounts. So for the first time since the 1930s, we have a decline in M2 on a year-over-year basis. It started in December. It's intensifying. It looks like it'll be down 3% in March. And I believe this has all the hallmarks of potentially a deflationary bust.
So first of all, I think we've both been reading each other's stuff from afar for a while. First of all, I actually agree on the medium to long-term thesis of technology-induced deflation, like the positive kind of deflation. I actually also agree that we're going to have a contraction that is normally associated with prices going down and so on and so forth. In this case, I think that, just like, stagflation was a regime that previously was thought to not be possible to have that combination of unemployment and high inflation at the same time, right? I'm just going to put up something on screen, which is So, for example, in Argentina, there was a period where you had both the protracted closure of the entire banking system and a tripling in the price of a dollar, right? So this is something where there was a huge economic contraction, but also people wanted to leave that economy for a better foreign currency at the same time, right? So those are things where what you're looking at, the tripling the price of the dollar, is the desire for exit, right? As opposed to having a strong thesis, right? Go ahead.
A flight to safety.
A flight to safety, that's right. As opposed to having a strong, like when you're in very atypical times, you can't really have a strong thesis on what's going on within a system, because things will go woo, 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 like this. You're not going to have normal relationships. I mentioned this over here, basically print trillions while hiking rates, that the Fed now has high rates, like SF has low crime rates. It says it does, but it doesn't. Haha. Okay. And the reason is that, like this is Bianca Research's graph. There's a lot of other graphs like this where in 1 week they reversed, the quantitative tightening. People will argue about whether this is, they'll say, oh, it's not QE because it's loans, and the banks are getting these loans and they have to pay them back under this BTFP program. Those loans are extremely generous, in one sense, extremely generous terms, because they're at par. They do have an interest rate associated with them, but a lot of people are obviously taking them up on this. And the potential result of this, Arthur Hayes puts it at 4 something trillion just for this, and obviously it's kind of going up like that. And so you have this weird thing. Then there's also the swap lines thing that they did internationally, which is like BTFP for other countries, for all their central banks. So you have this weird thing where they are printing trillions and hiking rates at the same time, right? They say they're hiking rates, they're seeing banks burst, burst holes in the side as a function of this, because they're, either insolvent or they have these huge losses. So then they're printing, but they're still hiking rates. And so, I think we're in this weird time of traditional economic relationships are not, not necessarily a guide as to what's going to happen. And I don't have a strong thesis as to what's going to happen within the economy, but I do think people will want to get out of this economy, at least in part, because Bitcoin is something, in one sense, you can think of there being, to first order, only 3 true currency pairs in the world: USD RMB, RMB BTC, and BTC USD. Because they're like 3 currency regimes, right? The Western system, where it's the Fed and all the central banks that are friends of the Fed. The Eastern system, the Chinese system, which is now actually expanding, as you've seen, like it's not just China, but it's China, Russia, it's China, potentially Saudi, Iran, it's African countries, even France and Brazil are doing deals and so on. A lot of the world is now starting to do deals that are denominated in the yuan. Those are big announcements. They're happening, coming very fast, and they're probably coordinated on some level, in the sense of those are big deals that take a long time to negotiate. So having them all announced lickety-split is important. And then finally, you have the BTC economy, which is outside the control of both the USD system administrators and the RMB system administrators. And I say that because you can think of the Fed as a system administrator. They're like, they've got like a video game where they control it. They can hit a button, they can freeze your account. Of course, not directly, not yet with the CBDC, but they can indirectly freeze your account. They can make numbers go up on the screen. Everything within Western financial system, they can, in extremis, do something like they did to the truckers of Canada or the Russians in terms of freezing assets. But they can't mint a loaf of bread. They can't control what's going on in the RMB economy, or at least not directly. And they can't freeze, seize, or inflate Bitcoin. The 21 million limit is outside their control. So my thesis is more about the desire to exit this economy than it is about the system dynamics within it, which I just find unpredictable, and I'm, and I don't have as strong a thesis on. I think it's quite possible that some prices go to the floor and some go up, but it's a desire for exit that I'm thinking about.
Okay, power pack there, and touching a lot of topics that we think about all the time. You are correct. We have never seen the Fed raise interest rates in a crisis. This has just never happened, which tells me that they're completely off base. And one of the ways they're off base is they have compartmentalized their responsibilities here. They're basically saying, oh, well, we have tools to deal with financial instability, with liquidity crises and such. But the Fed's primary role right now is to fight inflation. And so I think this compartmentalization confuses the fact that financial instability is going to impact inflation. And the way I think it is going to impact inflation is through a serious decline in the velocity of money. Now, because of your forecast, and I've been thinking about this for a while, but I wanted to do the arithmetic and sort of scenario test here. I'm going to actually put up a slide. So here is the velocity of money. And the way you get to a hyperinflation is if the rate at which money turns over turns up. Now, this velocity of money goes all the way back to 1960 here, early 60s, and it was going up during the 70s. Here in and it actually went up in the 90s, which I find curious, and I'm going to go back and study that a little bit, because that was a very disinflationary period. But here you can see we peaked out in 1997 during the tech and telecom bubble, as people were worrying about the economy shutting down as we entered the new millennium and computers not being able to take it. So there we started the decline, and it has been a very long-term decline. And you can see when we're this is velocity during the tech and telecom bust, and we come out and goes up for a while, and then it resumes the decline if you're in a disinflationary or a deflationary prone economy. Here is 0809, and it continued down because the fear coming out of 0809, this was going into it, the fear coming out of 0809 was just as intense. And then here we are at COVID, and this has been the increase in velocity since. Now, it hasn't even gone, I drew all these lines here, but it hasn't even gone back to this downtrend here. It hasn't gotten back there yet. And if we are correct, velocity is in the process of flattening out, and we believe because of this crisis is going to resume its decline. Now, just to give you a sense, in the fourth quarter, these numbers are firm, although they revise all of these economic numbers, and I'm sure we'll be in a recession when they revise it 10 years from now. But anyway, given what we have now, we had, in the fourth quarter, we had the year-over-year money supply really had flattened out. It went to zero. It had been as high as 27% in February of 21, and it's come all the way down to basically flatten the fourth quarter. But GDP on a year-over-year basis was up 7.3%, which meant that velocity had to absorb that. And it did. It was up 7.1% year over year and 11.4% sequentially at an annual rate. Now, in the first quarter, and I'm sorry if I'm getting too much in the weeds, but this has to do with MV equals PQ. And it's a macroeconomic concept. It's an identity. They have to equal each other.
Right, I'm familiar.
Right. Yeah. No, I know you are, but our audience, I don't think will be as familiar. Okay. So PQ is price times quantity. That's GDP. That's the production of goods and services and the pricing of them. So PQ. And then it has to equal MV. M on a year-over-year basis. In the fourth quarter, it went flat. And it looks like in the first quarter, it will be down 2.5%. And it seems to be accelerating to the downside. So what does this mean? The first quarter is pretty much put to bed. So it looks like we know that money is down 2.5% on a year-over-year basis, but down 5.7% at an annual rate in the first quarter, so from the fourth quarter to the first quarter. And this is really before the crisis, which occurred at the second half of March. Now, GDP is up 7.4% on a year-over-year basis. So that means velocity had to accelerate, or the rate of growth in velocity, to 9.9% on a year-over-year basis. And on a sequential basis, it will be roughly the same, 11.6% at an annual rate. But now we get into the second quarter. That velocity, just that trend line going down, it's a powerful force, and it may reassert itself here. So if in the second quarter, money is down 3.5%. Now, M2, 85% of M2 is demand deposits. And the demand deposits we get weekly, and they are continuing to leave the system, some for the money market funds, some for crypto, but they're leaving the banking system. And so that's down 3.5%. And the estimates for GDP, consensus estimates for GDP for the second quarter are roughly 4.5% on a year-over-year basis, which would be minus 2.8% on a year-over-year basis. And the way you could get there is with money going down 3.5% is velocity just staying flat. Now, I think velocity, which when you go through a crisis and the economy seizes up, velocity goes down. When I saw people lined up in front of Silicon Valley Bank, get their money, and they put some of their money under the mattress saying, I don't know what's going on, but I need to rush to safety. The equivalent was Bitcoin going from 19,000 up almost 50%, in the same time period. So you're absolutely right, Balaji. I agree with you completely. There is a flight to safety, but it is also into Treasury mutual funds, which have left the banking system and therefore will not be able to contribute to the production of goods and services in the economy. So 4.5% on a year-over-year basis, minus 2.8% sequentially quarter to quarter, that we have then entered a hard landing. And if you enter a hard landing, I think if I'm interpreting what you're saying is, okay, the Fed will just throw money at this thing. It'll get even more out of control. And I would submit to you that the risk is, you may be right, but the risk is what's called a liquidity trap. People holding back even more, not spending anything, fear, real fear. And hopefully that's not going to happen. But I think this crisis has raised the probability of it. And I do not know why consumers and businesses will migrate back to the banking system, given the very low rates there.
Cathie Wood and her guest, Mr. Balaji, commented in this video about the reasons that will lead the price of Bitcoin to reach a target of $1 million. Maybe not in the next 90 days, as Balaji said, but it certainly will in the future, and the main reason being huge corruption from world governments and the excessive money printing, and that will lead the inflation numbers to continue rising, and the only hedge against that nowadays that can provide huge result is Bitcoin. Hope you enjoyed watching this video. See you on the next one.